Good afternoon, everyone, and welcome to our Way Forward workshop, Leader Lunch Break. We are pleased to welcome two amazing, outstanding professionals today, Seth Task and Michael Cantor, to help us to understand this very confusing real estate market. Seth Task is the president in 2021 Ohio Realtors, meaning that he is the chief elected officer of the association and has responsibility for all action and activities of Ohio Realtors. He has been a realtor since 2005 and has appeared before the Federal Reserve Bank, the Federal Housing and Finance Agency, Rural Housing Services, and the Department of Housing and Urban Development as an expert in his field. He's involved in the Solon Chamber of Commerce and leads the task team at Berkshire Hathaway Home Services. Michael Cantor is the managing director, principal, and a founder of Allegro Real Estate Brokers and Advisors. He works with corporate, public sector, and real estate industry clients, not just here in Cleveland, regionally, nationally, and globally. He brings 25 years of experience in commercial real estate to all of the clients he serves. And he gives back mightily. Quite frankly, Michael, I don't know how you have time to do real estate with all that you do in the community. He serves on the American Jewish Committee, the Music Settlement, City of Cleveland, Cleveland Jewish Federation, the Government Affairs Group at Greater Cleveland Partnership, and most importantly, he is the president of the Leadership Cleveland class of 2012. He's a recipient of numerous awards, including multiple recognitions for the Weatherhead 100, and he has written countless articles. As one of his partners proclaimed, he can multitask like no one I've ever seen. Gentlemen, I turn it over to you to educate us.
Thank you, Marianne. Appreciate the introduction. That sounded better than anything I would ever say about myself. A couple notes. One is that my firm Allegro really is focused on occupier services in the office and industrial sectors. Seth is going to speak more from a residential standpoint. We will have some overlap. So I just wanted to kind of clarify that as we start to tackle this topic of what's going on with real estate during the, I don't think we can call COVID-19 post-pandemic anymore with the Delta variant. So while we're going through this pandemic, what is going on in the real estate industry? And as we talk about it, we'll talk about various sectors in the real estate industry and how, and the interplay. One of the overarching themes is the interplay, the impact that each of these sectors is having on the others. And so hopefully that'll generate some dialogue between Seth and me. I'm going to start out by describing the office sector with one word, which is mixed. We've seen clients over the last year and a half go about business as usual. We've seen others downsize. We've seen some just make short-term decisions, and with the idea of 1 or 2 year lease extensions. Let's see what the new normal looks like after the pandemic. I think as we're working through this pandemic and seeing that it's not going away anytime quickly, we're going to see a shift of office users starting to just figure out how they're going to operate in this current environment. All that said, the office market is experiencing generally slower volume and activity. I predict that there will be a net declining demand in the market, which is exacerbated currently by the delayed return to work plans that a lot of large corporations have, although smaller and mid-sized companies have been coming back to work for some time now. But I think that over time, we're going to see downsizings and consolidations that are the result of reconfiguration of space due to the work from home environment and the hybrid structures that different companies are coming up with to address work in office and work from home. A couple things. I think we all have to acknowledge that Cleveland's economy and basic economic fundamentals were softening before the pandemic. And as we saw with the census, that our population isn't growing relative to some of our peer metro areas. So some of these weaker demographic and employment trends are affecting all of our industry sectors and our job market is expected to recover more slowly than some of our peers like Columbus, Cincinnati, and Pittsburgh. One of the things that I can say about all the sectors that we can talk about today is that we're kind of conservative in Northeast Ohio in terms of construction, and there are limited new deliveries of buildings in every sector. What's really happening in the office market is that a lot of our older office buildings are being converted into multifamily. And again, this is where you see an intersection between office and multifamily. You'll see something similar between industrial and retail. But as we are taking buildings, for example, the Huntington Bank building, and converting it into the Centennial project, we're removing 1 million square feet in just that one project from the supply of office market in greater Cleveland. In February, K&D acquired the 55 Public Square building, which they intend to convert partially into residential as well. That takes a lot of additional supply off the market. So as a result, that's helped to keep office market vacancy rates at a healthy single-digit level. We're probably hovering in the 8 to 9% range currently. Rental rates have held steady, although over my 30-year career, rental rates in Cleveland, there are peaks and valleys, but they've held steady for 3 decades now, truthfully. And in 2021, leasing activity has returned to post-pandemic levels. Sales activity is modest and is below pre-pandemic levels. And as I mentioned, there's limited to no development in the pipeline, which is keeping the metrics relatively intact. Although I think 3 projects probably are appropriate to note. One is obviously that we are looking at the new Sherwin-Williams headquarters, and research and development facilities are about to be underway. Swagelok is building an expanded headquarters in Solon, or has built an expanded headquarters in Solon. And CBiz, the accounting firm, just announced that they're going to be anchoring a new 125,000 square foot office building on the Rockside Road corridor. So there's some, in some respects, some very positive activity happening in the office environment. I'm going to try not to touch on the multifamily environment too much. I'll let Seth tackle that. But again, there's been this, I'd say if I ever apply one word for multifamily, I'd say it's healthy. Vacancy rates are less than 5% right now. Rent growth is over 5% over the last year. And it's partly because there's been this shift in downtown Cleveland, including Ohio City, Tremont, University Circle, Little Italy. There's been this shift and this demand for people to move downtown. Now, when the pandemic hit last year, there was a temporary shift of people moving out of downtown into the suburbs, but it looks like that ripple effect is reverberating and coming back towards some downtown office or downtown residential demand. Millennials, Seth can speak to this, the millennials are aging into home ownership with current low interest rates. There's increased demand for suburban single family homes. But with Generation Z coming out of college now, there's demand for some of the millennial type housing that they're moving out of in the urban areas. And as baby boomers are becoming empty nesters, and now Generation X are becoming empty nesters, there's demand for people to move inward as well. So that's sort of the interplay between office and multifamily. Let me quickly talk about the interplay between industrial and retail. And really the one word I'd use for the industrial sector is that it's resilient. And there's resiliency, and the really positive note in what's making the industrial market hot is basically caused by the Amazon effect. E-commerce has accelerated demand for leased space, from fulfillment centers to last mile of delivery warehouses, basically modern bulk storage properties across the market. And Amazon is the tenant of a number of the largest sale transactions that have taken place over the last year and a half. However, Cleveland has a larger exposure to manufacturing, which holds back our industrial market a little bit because, as we all know, manufacturing is facing headwinds with they're competing for space with distribution and warehouse users. And those distribution warehouse users are driving up rents. But meanwhile, they're also contending with disrupted supply chains, reduced export growth, and labor shortages. So leasing volume overall has increased, again, probably driven more by distribution, but net absorption has been modest compared to other more logistics-oriented markets like Columbus and Cincinnati. New development and speculative development in industrial is limited, particularly considering the demand and the low vacancy rates as compared to these other markets. And as a result, our vacancy rates are remaining low and our rental rates are remaining steady and improving a bit. And then the e-commerce effect then has a negative impact on the retail sector. So the one word I'd use for the retail sector is that it's troubled. And it depends on what parts of the retail sector you're looking at. But the pandemic had an effect causing negative absorption for the first time in Northeast Ohio since the Great Recession in the year 2009. On the other hand, we have some big box retailers who have entered the market like Meijer and Menards. A lot of discount retailers are absorbing some of the square footage that has been made available. And at the same time, we're seeing some of the more traditional department stores closing. We've seen closures from JCPenney's, Macy's, a couple of Bed Bath & Beyond stores have closed. And then again, on the brighter side, the grocery anchored centers are in demand. So although e-commerce has included more home delivery of groceries, the grocery anchored shopping centers are still performing fairly well. And as different parts of the retail sector struggle, a lot of landlords are starting to focus on experiential tenanting of the retail centers. So that's where some of the additional positive activities happening in the retail sector. With that, I'm going to stop talking for a little bit and let my friend Seth Task speak a little bit about residential and otherwise.
Excellent. Thanks, Mike. So who'd have thought 34 years ago, and Mike and I were very good friends at Orange High School and graduated together in the class of 1987, that we'd be two of the leading experts in real estate in Northeast Ohio.
We would have had a good laugh about that.
I won't tell any of the stories about us headbutting walls or anything like that. All right. So anyways, Mike's, I love listening to Michael. He's an unbelievable expert in the commercial space and really just Cleveland in general. It's a tough act to follow, but I'll do my best. So, in the residential space, and as we get into questions later, keep in mind that as an officer of Ohio Realtors and also a director of the National Association of Realtors, I can answer questions about what might be happening at the State House or in Washington in regards to legislative or regulatory issues that are being discussed, some of which I'll offer, and then you can maybe ask questions later if you want, things that will be affecting both the commercial and residential space. In relation to the market, one word for the residential market in Northeast Ohio is hot. It continues to be hot. I've been talking honestly about this for years. I expected this market. I predicted this market 5 to 7 years ago. I said that an inventory shortage was coming, the likes of which we'd never seen. And honestly, it's really math. It's nothing more than that. People say it's COVID. COVID may have exacerbated it. You may hear of people who have moved back to Ohio. I have a client who moved here from San Francisco because their company allowed them to work 100% virtually, and they could buy a house much cheaper here. They actually took a pay cut to move back to Northeast Ohio, but they still work out of San Francisco. So you do have people moving into suburban areas, maybe back to a Northeast Ohio, because they're able to work from home, and that certainly has added to sort of this residential real estate boom. But if you think about it, let's go back to 2000, 2006, when the mortgage meltdown began. It exacerbated on August 1st, 2007, when subprime lending ceased to exist in one day. And then what I call, and it was called the giant slide from 2008 to 2010, where we were trying to predict depreciation. In fact, I got my license in 2005, went full time end of 2006. I didn't know real estate was supposed to appreciate. I only saw depreciation in the first 6-7 years of my career. And when I first saw appreciation in 2012, it scared the heck out of me. So, but that said, where we're at right now, I to some degree consider it, a 15-year market correction. Some of you can finally sell your house for more than you bought it for in 2005. And that's, I don't think there's anything wrong with that, right? I've been talking to people for months now as I'm interviewed that there's nothing wrong with appreciation. It's what's supposed to happen with real estate, especially residential real estate. It is a way to build wealth for your family or yourself, and that's the way it should be. If it continues, that might be something else. We don't see these huge high highs and the very low lows that you might see in these bubble areas like California and Florida. We're a more stable market, and I still think that that's who we are. So we'll talk a little bit about what some of those numbers mean. But when you talk about a millennial generation, that's the largest living adult generation in the history of the United States, much larger than the baby boomers. And they are now in their prime, as Michael said, their prime first-time homebuyer years. And by the way, the average age of a first-time homebuyer raised over the last few years from 27 to 31, and that's the middle of the millennial generation, is about 31 years old, depending on where you set the parameters. Some people will say 24 to 40. Depends on your parameters, but. This generation didn't believe in housing. The National Association of Realtors does a ton of research, polling people about housing. And, a lot of these kids, they watched their parents get foreclosed. They watched their aunt and uncle lose their house to short sale. They saw depreciation while they were trying to get student loans. And so they didn't necessarily believe in home ownership at the beginning of the millennial generation home buying years. And it took until now where appreciation sort of started taking hold, as well as the fact that underwriting a loan for somebody with a substantial amount of student loan debt is not as easy. And a vast portion of our millennials have a ton of student loan debt still. Some of the regulations in relation to underwriting those loans have changed over time to make that a little bit easier. And so now that generation, 4 or 5 years into their what would normally be a first-time home buying age, now they believe in home ownership. Plus the fact, when a couple, has a kid or two and they're in a 2-bedroom apartment, good luck telling them they don't want a house. So it's just the natural way of life, right? For people to own a home and want to live in a community and be in a school system or what have you. So that's part of it, right? This huge generation that wasn't buying homes, now they want to buy homes, coming into a marketplace. And realistically speaking, we would have been building homes too at the same time. Well, in 2008 and 2009, we built the same amount of houses approximately that we did in 1934 and 1935. Those are the 4 lowest new construction permit pulls in the history of the United States: the Great Depression and the Great Recession. And realistically speaking, a lot of builders went out of business. Some of them didn't even come back in business. We have a substantially crippled supply chain right now, and we have a very, very poor labor market. We're not telling our kids it's okay to be a plumber or an electrician or a carpenter or what have you, even though they're very good paying jobs. And so builders have a tough time, putting crews together. And so we stopped building in 2008. We never built really throughout the last, 10 to 15 years, nearly enough in the price range that was necessary to be able to supply inventory for the millennial generation. And what does that mean? It means there's not enough houses to buy. So as of this morning, there was, and I'll use Cuyahoga County statistics because that's I'm sure what most people want to hear. There were 2,048 active listings in the entire county. Okay, condo and single family, 2,048. Now, I've been looking at that number almost daily, since the inception of COVID, when this market really started churning. In March and April, that number was under 1,400. Now, this is a county of, 1 million people. And when you have only 1,300 active listings going into a spring market, and you've got this huge buying generation, what does that mean? That means 20 offers of property. And that's what was happening. Is that still happening? Yes, but not as much. As I say, that inventory has increased by about 50% to a little over 2,000. But to give you some perspective, as far as what's happening, the last 3 months in Cuyahoga County, there have been sales of over 2,000 properties per month over the last 3 months. That's the first time that's happened in recorded history of the MLS, that there have been that many purchases. So when you have this inventory, an active inventory of about 2,000, and again, last month it was 1,850. The month before it was 1,700. The month before it was 1,600. So it's starting to build up. Why is it building up? Well, a couple reasons. People think that they're going to get a good number for their house, right? Maybe somebody says, well, now's the right time. I can finally get out of the house, or I can finally put some cash away. Maybe somebody doesn't believe this market's going to continue and they want to get the top of the market. Whatever the reason, more people are starting to put their houses on the market, and that's helping the inventory. Interesting statistic on values. Values are substantially up. The average sale price of a property sold in Cuyahoga County last month was $237,000. 5 years ago, it was 162, just 5 years ago. That's great. Those are good numbers. And frankly speaking, that kind of an increase, while it's an average of about, call it 8 to 10% over a year over that period of time, it's not the crazy 15 to 25% you might see in some of these markets on the coasts. If it continues, will we see a bubble? Who knows? I mean, that's something that nobody can really predict. The question is how high does it go? I think when it comes to the point where can you build cheaper than you can buy existing inventory, I think that might be something that might change the market a little bit. But listen, go to Columbus and try to buy the same house, not LA, Columbus, because if you try to find the same 2,500 square foot colonial that you might be able to buy in a Cleveland Heights or what have you for, $300,000 or $325,000 or whatever the number, you're going to spend $500,000 in Columbus for that house. Or, a property that you're going to buy in, South Euclid or Lyndhurst or what have you for 150 is going to be, I'll tell you right now, my daughter, I just sold my daughter her first house in Columbus. She spent $205,000 on a 1,400 square foot house in Columbus. In an area that's just up and coming. That house would have been 150 here. So, that said, that residential market, is still doing well. I expect it to still do well. We're sort of jury's out as to whether or not the end of forbearance is going to affect the foreclosure market. The reality becomes is that the federal government set up the forbearance so that it does not hurt your credit if you went into forbearance, but you do have to start making payments when the forbearance ends. So we'll see what happens. We won't know for a few months as to whether or not we will see a higher level of foreclosures. On the rental side of things, as Mike said, the rental market is extremely strong. It continues to be strong. Several investors are okay with a 7 cap. They come from California. I have investors right now from the state of Washington, state of California, looking for multi-family properties in North Collinwood, along the Detroit Shoreway, Shaker Heights, you name it, because they can get 7 or 8 cap. 8 years ago, nobody would talk to me if I couldn't get them a 15 cap. So, you know, it's just incredible how that market has changed. I remember, I can't remember what year it was. It might have been 11 or 12 or 13, where I was looking in the Shaker Heights community for a multifamily property in the Lomond area or the Winslow area, if you know those areas. And I couldn't find a two-family comp over $100,000. Those properties were selling for $200 to $225 every day of the week and twice on Sunday before the mortgage meltdown. And guess what? They're finally back to those volumes. I just put a property under contract on Linfield today at 210. So that market is not, I don't think, higher than where it was pre-meltdown, but it's back, finally back where it used to be from those pre-meltdown days. You know, that said, you know, the multifamily market, you know, Mike makes a great point. There's a lot of crossover. You know, we're talking in Washington about lobbying about changing the tax code to allow more help, not just from a tax perspective, but also for an assistance perspective for developers that can convert commercial space to affordable housing, because we have a real affordable housing challenge. You know, builders right now are building $500,000 and up, and we have a real shortage under $500,000. Last thing I'll say is this, is that just from a multiple offer perspective, a lot of people are talking about, you know, the multiple offer situations. Are they still happening? I remember, you know, for the first time last year in the history of the MLS, and the MLS goes back to 1990. So you know, when I search the MLS, I can go back to 1990 and get any statistic I want. The very first time I ever saw the list to sale price of 100% was last year. First time it happened was in June of last year. And it stayed at 100% or over until January. And in January and February, it dipped to 99.7. And then in March, it went back to 100, and it's been over 100 since. So, you know, we're still seeing multiple offer situations. At this point, it's on a case-by-case basis, depending on what community you're looking at. And by the way, that's the whole county. That's from 0 to infinity. So that includes, you know, properties over 7 figures when you're talking about these averages of average sale to list price. And oftentimes that over 7-figure market will sort of skew those numbers, because, you know, property listed at 1.5 million could easily sell for 1.3 million. And that $200,000, you know, we're talking about a volume gap. So, and that's just not happening even in that market. So that said, that's your residential update. You know, I'm going to kick it back to Mike, and, you know, maybe we'll just bounce some thoughts back and forth about how these markets intermingle.
I think one of the questions that I saw in the chat had to do with whether or not there is out-of-state investment happening in Northeast Ohio, and maybe I can tackle it from a commercial side and you can tackle it from a residential side. I think that one of the things we see in Cleveland is that when other markets get really hot and the pricing in office and industrial retail properties becomes frothy on the coast and in some of the other hot metro areas across the country, is that investors from those metro areas start to look at mid-America markets like Cleveland as a safer investment. We are seeing some investment from out of state. A lot of it is premised upon fully leased properties. Some of the Amazon leased properties I spoke about earlier have traded from local developers to non-local investors. But as long as our basic market economics are flat, primarily our population and job growth numbers are flat, we don't see we're not a hot market for out-of-state investors. What are you seeing on the residential side, Seth?
Yeah, and I would say that what's interesting about that is the difference between the residential market and the multifamily market. And in the multifamily market, I'm going to include mixed use, which there's some crossover between Mike and I do some commercial. About 15% of my business is commercial and 85% is residential. But we do have a substantial amount of investors from out of state. And I'll tell you that when the mortgage meltdown happened, when it started, we had a substantial amount of international investment here coming from everywhere. I had clients from Australia, UK, Singapore, China, Israel, you name it. I mean, I probably, it'd be interesting if I put a pin on every country that I sold a property to. It was a lot. But now, most of my investment from out of state is California, is West Coast, California, Oregon, state of Washington, all very hot markets, Texas, New York, Florida. These are investors who are, interestingly enough, I can't disclose who it is, but somebody mutually that Mike and I know is from the state of Washington that went to Orange High School, is buying a property back here in Cleveland that is it's a mixed use property. It's 25 apartments and 12 storefronts and office. It's 2 buildings together in Cleveland Heights. And why? Well, because he can only achieve a 3 cap, 3% return basically on cash in his state. And so they're coming back here because he wants to come back, visit family, and own investment property. I have a lot of different realtors, other real estate professionals who are buying multifamily properties, 2-family, 3-family, 4-family, here in Northeast Ohio, because those really you can achieve anywhere between a 6 to 8 cap right now on cash, and then if you're leveraging, you're 9 to 12%. And so we're seeing a ton of that, and I think that's really helping to push that residential market, especially considering the fact that rents are also increasing. And the rents are increasing, why? Because these millennials have nowhere to buy, or the Z generation behind them coming out of college, they want to rent, they want to be downtown, they want to be, somewhere where, they can walk to a bar, a restaurant, a convenience store, a McDonald's, what have you. And all of those areas are doing very well on the rental side. And so, what you used to rent for $700 in Cleveland Heights or Lakewood or whatever is now $800, $850, $900, 2-bedroom units.
I guess one place I would add on to what you're saying, Seth, is in a multifamily, we are seeing new development come from out-of-state developers, or out-of-market developers at the very least. Casto out of Columbus is building in Ohio City. A Chicago developers building in Ohio City across from the West Side Market. The top of the hill in Cleveland Heights is being developed by an out-of-state developer. So particularly multifamily residential based projects. They may have retail on the first floor. You could call it mixed use if you'd like. But we are seeing that maybe it's because our developers in Northeast Ohio are more conservative, that we're seeing some of the new developments take place from out-of-state developers.
That's a great point. I have to tell you, and I'm sort of disappointed I didn't get this deal off the ground, but I have a soft spot in my heart for East Cleveland, City East Cleveland. I feel like it's been left to die. The Tax Cuts and Jobs Act allowed for opportunity zones and investment in low to moderate income areas, and choosing those tracks became a political football, which is unfortunate because realistically speaking, the entire city of East Cleveland should have been an opportunity zone, in my opinion. But there's those of you who might remember the old Huron Hospital, which was on Euclid Avenue, and behind it is a 13-story apartment building that's vacant and completely dilapidated. I mean, I had out-of-state investors from San Francisco that were going to do it. Nobody locally would take this thing on as a multi-million-dollar project. It ended up being too big of a project, too vast, and frankly, these investors didn't believe enough in the municipality at this point to be able to service the additional tenants that would be, or the purchase. I wanted to do condo because we need owner occupant, but the tax policy doesn't doesn't support that, right? Our federal tax policy supports rentals. That's another reason why it's going to be tough for some of this redevelopment in commercial space, to help solve the affordable housing crisis and the workforce housing crisis, because the tax policy doesn't allow for these. But I thought it interesting that an out-of-state investor would have taken that on had it been had the tax policy worked, and had they believed enough in the city to be able to, EMS, police, fire, all that, be able to support that building. There's a question about in the chat about how do we think an increase of interest rates would impact the residential market. Listen, the fiduciary, or the fiduciary policy, or the financial policy of the government always, to some degree, affects the real estate market. Now that said, we're still at 3%, 3.25%, from on a lending rate right now. How high does that have to go to really affect the market? I don't know. I mean, I say this all the time. I remember dancing in my living room because I got 8 1/8 in August of 2000. And I'm sure there's some of you on this call. Now, Mike and I were in 8th grade at the time, or whatever we were, but you'll talk about how you got 18%, okay, in 1981 or 80 or 79 or whatever those years were. So yes, I think that an increase in interest rates would affect really all real estate markets. The question is how high do those rates have to go in order for it to really create a tick? And I would say, I don't think that, a raise personally from, 3 to 4% is going to affect the market very much at all. I think we'd have to start seeing 5s and 6s again, sort of pre 9/11 rates before it really affects the market from a because we just have too many people. There's just too many people in the buying market. Something has to happen bigger than a 1% jump in interest rates to really affect the market.
There was a question about whether or not we're seeing non-Cleveland companies with interest in the commercial sector. And I guess my first response to that is there always are non-Cleveland companies that are entering this market. I don't think that we're seeing anything unusual. What is unusual is that during the pandemic, LinkedIn indicated that Cleveland was one of the 10, I think one of the 5 most common markets for people moving from somewhere else to Cleveland. U-Haul did a similar analysis, did it at a state level, and said that Ohio is one of the top 10 markets, top 5th or 6th maybe, 4th or 6th, somewhere in that range, in terms of one-way U-Haul rentals, going from starting somewhere else and ending in Ohio. So, as we've seen some movement, at least in the work from home arena, Seth talked about somebody from San Francisco moving here. That's a trend that could drive employers to have outposts in Cleveland, because that's, their employees want to be in Ohio, partly due to the cost of living. There's another question about whether or not, about the lagging downtown retail environment that we're seeing, and whether or not with the increase in downtown living, we will see a recovery in downtown retail. I think that we will. I'll give you one good example. If you look at the block of Euclid Avenue from East 9th Street to East 12th Street, for over a decade, I called it the ghost town block. It has now been fully renovated into residential, from Heinen's to Playhouse Square, and a lot of the retail space is still vacant. I think that if and when things normalize post-pandemic, you'll start to see that there will be retail demand to support that increasing residential base downtown.
Yeah, I would agree with that. I think, listen, I think that people have very short memories. I think that 9/11 taught us that, right? I mean, there was a lot of things that we thought were going to change after 9/11, and some did, like our airports and what have you. But, I was in the restaurant business during 9/11, and 9/11 put my restaurants out of business. But because people didn't want to congregate, right? They didn't want to go to eat in the same place. They didn't want to go to stadiums or what have you. But that all changed very quickly, and I think that that'll probably be the same thing again here once COVID is in the rearview mirror. I think there's going to be a lot of things that'll change. I mean, honestly, I went to school in Chicago at Northwestern, and I'll tell you, I used to drive to Chicago. I would get off at the south side, at the south side of Chicago, at the first Lakeshore exit, where I shouldn't be getting off. I'd want to drive Lakeshore the whole way, because that's how you build a city on the lake, is Chicago. And I believe in Cleveland, always have my whole life. And I think that we're going to see, I think there's a lot of new players, developers in the marketplace. I think you're going to see a lot of local Cleveland money. Mike can speak to this better than I can, but you sort of feel it. I think we feel that there's a lot of money coming to Cleveland, a lot of people who believe in Cleveland. Listen, we have 20% of the entire world's fresh water supply right at our doorstep. And if you don't think water is going to be one of the most, highest commodities on this earth every year moving forward, think again. So we're very fortunate, I think, to have Lake Erie right here, and we've got to protect it. But I see somebody building something like a water tower at some point. You can't build all of these residential units. And finally, Heinen's was the smartest one to finally put a grocery store downtown. They're going to need another. There's going to need to be more retail downtown if we continue to add to the residential market downtown. I think that it's a foregone conclusion that it will happen.
Yeah, quick note. Somebody just asked a question about Tower City and the vacancies in the retail at Tower City. One thing to be aware of is that a large component of the terminal tower is being converted into, or is in the conversion process into multifamily. So again, like the former ghost town block, it could be that bringing residents into Tower City will help to lift the retail spaces in that complex.
There's a question there. It says, it seems like houses are there's a lot of houses in rough condition also being sold quickly. Do you feel the idea of flipping and renovating homes is becoming more common in Cleveland? Well, let me start with that. Flipping in Cleveland, I mean, there should be a show flipping in Cleveland. I've project managed 100 flips. I tell you, at the beginning of the mortgage meltdown, I remember somebody emailed me. This was in 2008 or 9. A lead came through, and this email said, MLS number, offer $2,500. MLS number, offer $3,500. I'm like, what is this? Like, you can buy a house for 35. I didn't even know, like, as the market was tanking, because I didn't do a lot downtown. I'm from, we're from Orange, and I did a lot in the Heights, and I did a lot in at the time I lived in Aurora. So I did Aurora and Chagrin Falls and Solon and what have you. But I looked these MLS numbers up, and sure enough, these properties are listed at $4, $5, $6 grand, 2-family properties. The first property I sold that was like that was 750 East 96th Street. That's the corner of East 96th and St. Clair. And, I remember like it was yesterday, and we got it for $4 grand. I went to the property. I had the combination from the agent, but I walked through the front window, and I didn't really need that combination. And I took pictures for the guy, and he's like, you know what? I don't want to keep this. I want to sell it. So he tells me to list it. I list it for $7,300, and I get emails from all over the world. You can buy a house for $7,300. And that turned into this, people from everywhere wanting to come to Cleveland. This was, 13 years ago. Well, I will tell you that when at the height of the meltdown, 37% of every transaction, every residential transaction, was a distressed sale. 37%. That's either a short sale or a foreclosure. So there was a lot of inventory then to buy. And so flipping was extremely prevalent. And it has been prevalent for several years. It's much tougher now because we don't have the foreclosure rates that we had. In fact, we have less foreclosures now than we did pre-meltdown, pre-everything. Our foreclosure rates are in the 2 to 3% range, very low. So there's not a lot to pick from when it comes to flipping a house. You almost have to find it off market. That said, because values are so high, if you're able to steal a house somewhere, you absolutely can flip it. So it's much tougher to find.
So apparently we've run out of time to answer more questions, but we really appreciate everyone's participation today, and some great questions help to create a good dialogue here.
Yeah, thank you
Michael,
very much. Appreciate you having us.
Well, thank you for making time to join us. Michael and Seth, this conversation clearly could have continued through the balance of the afternoon. I know there were some questions you did not get to, and there were others that came in privately to Rachel. So we'll save the chat and we'll follow up with you to make sure that everyone's questions get answered. Thanks to all of you.